93% of traders in India lost money last year. Not didn't hit their targets, not broke even, lost money. If trading really worked the way it's sold online, if intraday trading and options trading could reliably give you daily income, India wouldn't look like this. We wouldn't have millions of stressed salary professionals, rising household debt, and people desperately searching for side income. We would have an entire generation quietly living off trading profits. But that's not what's happening. Instead, we are seeing more people trading than ever before. More apps, more indicators, more workshops promising daily income. And yet, more losses, more silence, and more disappointment that nobody likes to talk about. SEBI's own data shows that 93% of individual traders in India lost money. And today, we are not reacting emotionally to that number, we are breaking it down calmly. We want to understand why this keeps happening, why even smart, hardworking people get trapped in it, and what's a right response actually is before trading quietly damages your finances. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. I've spent years studying why people struggle with money, not just the math, the psychology, the behavior, the gap between what works and what feels right. And nothing shows the gap more clearly than trading. Let me paint a picture for you. Imagine two people, same salary, same starting capital, both want to grow their wealth. It's obvious, right? One opens a trading account, starts watching charts, takes weekend workshops, gets few wins, then a loss, then another loss, then a recovery trade that goes wrong. The other opens a demat account, sets up a monthly SIP and forgets about it. 3 years later, the trader has spent hundreds of hours, felt the highs, felt the lows, and is still trying to get back to zero. The investor barely remembers checking their portfolio, but their money grows by 40%. Why does this keep happening? Because trading isn't failing people due to bad luck. It's failing them by design. Let me explain. See, SEBI, the Securities Exchange Board of India, released a study covering 3 years of data from financial year 2022 to 24. Here's what they found. Over 1 crore people traded in futures and options and 93% of them lost money. The average loss? Nearly 2 lakhs per person. I'm not sure you got that. Read that again. Didn't get their target, lost 2 lakh rupees after fees, after strategies, after watching all the videos. But here's the part that should make you angry. Only 1% of the traders made more than 1 lakh in profit, just 1%. Now, some people will hear this and say, okay, futures and options is risky, I'll just do intraday trading. SEBI studied that too. 71% of intraday traders lost money in a single year. And here's the twist nobody expects. The more often people traded, the worse they did. More trades, more decisions, more losses. This breaks the common belief in trading that more activity equals opportunity. It doesn't. More activity usually means more emotional decisions, more fatigue, and more mistake that quietly compounds. Let me show you something. Look at this chart. Here you can see the blue line rises slowly and steadily over a long period around 10 to 15 years. The line represents a broad market index. It doesn't spike dramatically, it doesn't promise excitement, it simply moves upwards over time. Meanwhile, the orange line, it's a roller coaster. Sharp spikes, sudden crash downs, constant movement. Both lines are exposed to exact same market, same economy, same news, same opportunities. So why do they look so different? Because the orange line isn't just showing market volatility, it's showing how human behavior inside the market. Fear pushing people to sell too early, greed pulling them back at the worst possible moment, overconfidence after a lucky trade, and panic when next 3 trade goes wrong. The blue line works because it removes emotions from decisions. You invest, you wait, you let compounding do what it's designed to do. The orange line demands constant decisions. Every red candle tests your discipline, every green day makes you greedy, and over time, those micro decisions quietly destroy returns. This is why markets reward patience but punish overactivity. Now here's where it gets darker. Despite SEBI publishing these numbers publicly, despite repeated warnings, the trading workshop industry is growing faster than ever. Why? Because the marketing is brilliant. You see the screenshots of profits, you see the testimonials from students who made 5 lakhs, you see the lifestyle, expensive cars, luxury trips, financial freedom. What you don't see? The silent majority who paid the fee tried the strategy and quietly exited the market after losing everything. SEBI has actually called this out. They've banned unregistered advisors, imposed fines, made it illegal to advise trading returns without audited data. They found something interesting and shocking. Some of the people who promised 25 lakhs from 25,000 had themselves lost tens of lakhs in their own portfolios. Now let that actually sink in. Want to hear the best part? The teachers themselves were losing money while charging students to learn their secrets. But here's the problem. For every ban, a new Telegram channel appears. For every penalty, a new Instagram reel goes viral. Marketing adapts faster than enforcement, and people keep entering trading because of one thing: hope. The hope of faster money, the hope of escaping the slow, boring path, the hope that I'll be different. Let me actually be direct. Trading is not failing people because they lack education. It's failing them because it demands a level of emotional control, time management, time commitment, and statistical patience that simply doesn't fit into most working lives. Actually, think about it. A salaried professional trading on a metro, between meetings, during lunch breaks, who are they actually competing against? Full-time professionals who breathe these numbers, algorithms that execute in milliseconds, institutions with research teams and billions in capital. If these professionals still fail sometimes, no weekend workshop can change that reality for you. And here's the part nobody wants to hear. Every hour spent watching candles, tweaking indicators, chasing recovery trades, that's an hour not spent building your real skills, not increasing income, not compounding actual investment. Even the small losses consume enormous mental bandwidth. For most people, trading is a mismatch of efforts versus outcome. Market don't reward activity, they reward alignment. And for most participants, long-term investing aligns far better with real human behavior, real careers, and real lives. Or let me make this concrete with a story. Meet Rahul and Ankit, both 28 years old, both earning 80,000 a month. Rahul discovers trading. He's smart, analytical. He takes a 15,000 workshop, starts with a 2 lakh capital, watches charts during office hours, checks his positions during lunch. Some month he wins, some month he loses. His mood starts following the market. He snaps at his wife when there is a red day, stays up late watching US markets. And Ankit? He puts 2 lakh in index funds, sets up a 20,000 monthly SIP, then focuses on something different. Getting promoted at work, building a skill that increases his income. 2 years later, Rahul has spent 400 plus hours on trading. He's up some month, down others, and net result, he's roughly back where he started, minus the workshop fee and trading charges and 2 years of stress. Ankit? His investments grew 35%. His salary increased 60% because he's focused on his career. His SIP contributions also doubled. And here's the key. Ankit isn't stressed about money. Rahul checks his phone every single hour. Same starting point, same intelligence, different approach, completely different lives. This isn't just a story. This is what SEBI's data looks like when it walks, talks, and lives in real households. One more thing before we talk solutions: options trading. The deepest damage of all. Options promise high returns with small capital, but leverage is a double-edged sword. It magnifies gains and, more importantly, mistakes. SEBI's data shows that 91% of options traders lost money in financial year 2024. 91%. Even after regulatory curbs, even after warnings. Options require probability thinking, strict position sizing, emotional discipline, not telegram tips, and definitely not stop-loss alerts from strangers. Most retail traders enter without these skills. One bad expiry wipes out months of efforts. SEBI has tightened rules, cracked down on misleading promotions, but regulations cannot fix psychology. So what's the solution? See, I'm not going to tell you that trading is evil or that you should never try it. I'm going to tell you the truth. If you want to trade, treat it like a profession, not a side hobby, and definitely not a get-rich-quick scheme. That means starting with capital you can afford to lose completely. Focus on risk management before actual returns. Paper trading for months, maybe actually plan for months before real money. Keep a journal of every single decisions, understanding that 100 mediocre trade beat one lucky win, and accepting that doing nothing when there's no opportunity is the skill. Trading requires time, emotional control, and the patience to sit on your hands when everything inside you screams to act. If you don't have that commitment, the odds aren't just unfavorable, they are destructive. But if your goal is wealth creation, investing remains the superior path for most people. Not because it predicts market, because it respects time. It removes the need to constantly be right. It lets compounding work quietly in the background while you're building your skills, increase income, and live a life outside the screen. The most powerful financial decision most people can make isn't finding the right stock or the perfect entry point, it's choosing the right approach. See, SEBI's data is very clear. Year after year, most traders lose money. Not because they are dumb, because trading demands what most people don't have: emotional control, endless time, and the ability to survive being wrong repeatedly. More activity doesn't mean better results, it usually means more mistakes. Flashy marketing keeps working because hope is powerful. But markets reward patience, not excitement. Long term investment keeps compounding quietly, while most trading journeys end in frustration and lost capital. If this video helped you see things differently, share it with someone who's thinking about trading without understanding the risk. And tell me in the comments, are you trading, investing, or still figuring things out? I read every single one. That's it from me. I'm Nikhil. Subscribe to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.